Good morning. I'm Jim Mintert, professor and director of the Center for Commercial Agriculture here at Purdue. And I want to welcome you and thank you for joining us for our webinar today, Managing Your Farm in an Economic Downturn. With me today are my colleagues, Dr. Chris Hurt, professor and extension economist here at Purdue, and Mike Boehlje, distinguished professor and extension economist here at Purdue as well. Before we get started, I want to point out that if you have some questions during the course of the webinar, you can simply email them to me here at my Purdue address, jmintert@purdue.edu, and we'll be monitoring those emails during the course of the webinar and I'll address them as they come up. So if you have a question, don't hesitate to send us an email. If we don't have a chance to address it during the webinar itself, we'll try and address that later today as I have time. So with that, I thought we'd start off, Chris, talking a little bit about the changes in our economic environment and agriculture, because we've looked at that in some depth. So let's take a look at that over a long period of time.
Yeah, this is a long period of time. This goes back to 1900, so we're well over 100 years of data. So what we're looking at here is the inflation-adjusted corn revenue per acre in the United States. Now, in more recent years, insurance has been very important, so we have had to add insurance into that. But what we see are really 4 periods where we had some surging revenue. And in all of those cases, that was primarily due to prices moving up sharply. As we look at the data here, we can see World War I, the mid and late teens was one of those time periods. And of course, one of the things we know about that particular surge was that it was followed then by a long period of very low returns. Then World War II was not as much of a surge, but you see the real or inflation-adjusted returns based on, this goes to 2014 or current dollars, up to about $700 again. And what we see is this maybe doubling of revenues coming from a much lower base, then doubling, and then moderation. So we really talk about that World War II cycle as more of a boom moderation cycle. Then of course we know the 70s and 80s, the more recent time period in terms of a boom bust cycle, and that one is very clear certainly to many people. The time we have been through here since starting 2006, again we saw those revenues increase by double or even in some of the years near triple the increases in revenues. And now it seems that perhaps we are setting back towards a moderation period. And again, I think we mostly are talking about this a boom moderation period of going from very high revenues to something much lower.
So Chris, just a couple of points here. It looks to me, if you look historically, the better times have been a little bit shorter than the not such good times. Is that a fair statement? I mean, kind of a boom-bust cycle with short peaks and long troughs. Is that kind of right?
Yeah, that's exactly right. I think we have generally something in the range of 7 to 10 years in terms of sort of those good times. That seems fairly parallel to what we've seen so far here. And then, as we see in several of these cases, some long periods. We look at a 30-year commodity cycle, and that has that 10 years of kind of the boom period, and then with a long time, a couple decades on the downside. Yeah. Now again, I think we'd have to sort this one out, and we don't want to be so bearish, I think, in this particular time of saying that we're going through a long extended period. But I think it does add a note of caution.
That's right.
Because we've had the upside. And one of the things we see on the upside of these revenues is it takes time to get a supply response.
Right.
So we've had that time to get the supply response. And what we see in the world now on basic crops is that supply is caught up with that big demand growth.
Right.
So we don't have those shortages as we have had in several of the years. So again, I think this would be a fundamental that says, okay, we're turning to a different time period.
Right.
And that time period could easily last at least 3 to 5 years.
Yeah, and I think we would think we could make a lot of adjustments in a 3 to 5 year time period. I think right now we're still waiting to see, is this really going to be the downturn? It feels to us, I think, we're going to say that probably is. But I think a lot of producers, a lot of agribusinesses are saying things like, well, we saw corn at $3 a bushel before, back in '08 with the recession and into early '09? Are we going to bounce out of this? Will we come back to $5 and $6 corn? Again, we think the fundamental difference is the fact that supply has caught up with demand.
Yep.
And that is a very much different situation than those demand surges we had, corn for ethanol and big purchases by China on soybeans.
Yeah, and what, about 170 million a day, about 8% increase in the total amount of land in production in the world today, which means we build a bigger factory, and generally we don't pull back that factory in agriculture like you do elsewhere, so we got to have demand growth kind of sop that up before we're going to have a really significant and permanent price improvement again.
Well, I think that's right. And again, right at this point, we need to, the marketplace is discouraging some of that supply growth.
Yeah, yeah.
And again, this startles a lot of people, but what we need to do is get the world to slow down converting in acreage into crop production.
Right.
You know, we need to slow down the rate at which the world was putting irrigation systems in, putting tiling systems, and other lots of technology going in to produce increase production overall. This is the function of the marketplace. If you think about a market economy like we have, lower prices send signals to those suppliers to slow down the rate that they're expanding supply. Not unlike we're hearing in the oil market right now with Saudi Arabia saying, we've got too much supply. And of course, they're a big participant, and they're saying, we can pump oil lower price than you can. So let's think about this supply side. So I think there's a great example. Corn and oil are really kind of linked together fundamentally at this point.
Let's take a look at some revenues and cost for producing corn in Indiana, Chris. You've looked at this in some detail, especially over the last 10 years, and quite a change here in the last couple of years, and looking ahead the next couple.
Well, that's right. And to me, this kind of summarizes, at least for people that like to look at charts, it summarizes the boom period and now maybe this moderation period we may be going through. Let's start with the red line. The red line is revenue per acre average here in Indiana. So revenues, of course, come from both the marketplace, they come from government programs, and in 2012 especially, we have to put insurance in all these years. So crop insurance is in here as well. And what we notice about the red line is the sharp increase from 2005, that's on the left-hand side, that is the last of the $2 corn in the Midwest. Then moving up to the middle of the graph, not just a little, but huge amounts. So from about $440, $450 of revenue on average to $950. That's a $500 increase per acre. Now, that $500 increase, we have 6 million acres. That's $3 billion more revenue in 2011 crop than we had in the 05 crop. These are huge amounts of money. This is just Indiana. This is just corn that we're looking at. The second important point to get out of this is the blue line are our Purdue budgets that we develop each year to look at the total economic cost of production. And by total economic cost, we're putting all the input cost, the variable or direct cost we call them sometimes, plus machinery depreciation goes into that, so recovery of expenses of machinery and family living expenses and cash rent. So we have for every acre of land, cash rent, machinery, family living expense, and the inputs. And what we see on the cost structure, and we think this is very important to where we're going to be talking to you here today, that cost, the blue line, don't go up immediately when the revenues go up. So we set ourselves up on the left-hand side of that graph for the time from 2006 to 2012 and 13, where revenues are going up quickly, costs are also going up, but they tend to go up more slowly, and they lag 1, 2, or 3 years. So that sets us up for the red line on the left-hand side of the graph being way above the blue line, big profitable margins for agriculture. Now, of course, revenue is primarily determined, market price is important, yields can be important as well, but what we've seen is corn prices falling from that $5, even $6 and $7 range back for the 13 crop to $4.50, and now the 14 crop $3.50. And so we see the revenues really fall quickly. but stickiness in terms of the cost of production. And of course, what we want to observe over on the right-hand side, which extends 14, 15, 16, and 17, and that is that we have negative margins, and that is revenues are not covering the full economic cost of production. Now, projections for 14 to 17 are based on about $4 corn and around $10 beans. We don't know what those revenues are going to be. Those are roughly what some ag economists and futures markets are talking now. But I think another important point we have here is that if crop prices can't recover more, then what that says, to get back in balance, we will have to see some cost items adjust downward. Now, nobody knows how this will work. Will we get corn prices, bean prices, wheat prices somewhat higher, or will we have to drag these costs down? But the world has changed, at least this visual tells us, from tremendous margins, from a bigger and bigger economic pie that everybody wanted part of that pie, now to a smaller pie, $100, $150, $200 an acre, smaller pie. And the question is, who's going to take those cuts?
Yep.
And that really brings us to the subject of our webinar today, and that is to talk about some management strategies you can use to not only survive, but really thrive in this kind of an economic environment. And as an industry, we've been through a lot of this before in the 1990s and in the first part of the 2000s, prior to the 2005-2006 timeframe. So let's talk about some of those management strategies. We've really got 5 different categories to consider: financial, input purchasing, execution, or how you manage your operation on a day-to-day basis, marketing strategies, government programs, and crop insurance. And of course, we addressed government programs and a little bit of crop insurance with our webinar just a couple of weeks ago. But we want to focus really on 3 of those categories today. We're going to talk mostly about some financial management strategies you can pursue, a little bit about some input purchasing strategies, and then we're going to wrap up talking a little bit about some marketing strategies. So with that, Mike, let's talk about some financial strategies that we think people can put in place not only the next couple of years, but actually some of them right now.
Yeah, that's right. And so let's just kind of at least get some of the ideas in front of you to think about. And probably the first one that we talk about in this financial area, Jim, is this whole issue of preserving working capital. And working capital is really kind of the amount of financial cushion you have in your business to handle the downside that we might be facing. We technically calculate it as current assets minus current liabilities, although what we really try to do is to put it in the context of what the size of the business is. So frequently we divide this current assets by current liabilities, divide it by gross revenue, and we like to have historically somewhere about 15 to 20% of our gross revenue being kind of a financial cushion in terms of current assets, current liabilities, or funds that we would have available to handle a shortfall, take advantage of opportunities that might occur, et cetera. In this time, we're talking about maybe upping that percentage, trying to have somewhere closer to maybe 25 or even 30% in terms of a working capital position. And the other part of this that we sometimes think about is that, okay, something that we frequently refer to as the burn rate on working capital. So what we worry about is that if I say buy machinery and use my cash to buy machinery and borrow money, it sounds like a good idea. Don't want to borrow any money, going to use cash to do this. Whoa, wait a minute, now I've destroyed some of my working capital, and so I've taken some of that working capital out of my business. Well, in the past 3 or 4 years, with the margins that Chris showed us just a bit, we've been able to rebuild that the next year through profits, right? So, we didn't have to worry about that burn rate. Well, now, those profits aren't going to be there, according to Chris's numbers, and I think Chris is right on, to be able to rebuild that working capital. And so now we talk about how fast we are going to be burning that working capital position. So one of the things we do is say, okay, if I've got, say, $100,000 of working capital, and I'm going to have maybe a $50,000 operating loss this year, be $50,000 short, that means my burn rate is 50%, right? I only got 2 years of working capital. Now, I could have, in the past, rebuilt it, so I'm okay. Whoops, maybe I can't rebuild it this time. So that gives me 2 years of cushion. That's a pretty short cushion. So another way to think about this whole issue is my burn rate on my working capital. Farmers need to kind of calculate that out and figure out what that burn rate is going to be. And it's a little back-of-the-envelope calculation that helps them understand how much cushion and how many years they have to be able to kind of have this this buffer that they really need. The other thing and that kind of drives us to a really important decision that we need to make in terms of financial strategies, and that is that this is probably going to be the time to really pull back on these capital expenditures. I mean, that's one of the first significant financial adjustments you can make. What we call no CapEx, no capital expenditures. Now, it's going to be a really interesting phenomenon given what happened this week, because we did pass in Congress the 179 rules that allow us to basically write off for tax purposes $500,000 of capital expenditures for a very brief window of time, right? For the next, 2 weeks?
End of the year.
End of the year. It doesn't extend into 2015. It's just right now. And so there's an awful lot of farmers that are going to be saying, okay, in this next 2-week period of time, I can get some really good deals on, because machinery and equipment people are trying to kind of move product now, right? I can get some really good deals on some machinery and equipment, or some tile, or some storage, or some things, probably deals I haven't been able to get up to this point. And so it's going to be pretty hard decision to say, nope, wait a minute. Maybe I ought not to do that. Now, should I do that or not do that? Well, certainly you worry about what is going to do your cost structure longer term. But maybe the concern we ought to be more worried about is, do I have the working capital to do it? If I'm going to take cash I have, if I got a lot of excess working capital, that's one thing, right? To get maybe the tax benefits is worthwhile. Although you ought to worry about the long-term cost impacts no matter what. But if it's going to result in my working capital being, quote, under what is a reasonable normal amount, and I am, as we indicated, not going to have profits to rebuild it next year, maybe I ought to say, I'm going to have to let this really good deal pass. I just have to be really cautious about that whole issue of the working capital position.
And Mike, maybe to push that just a little bit further, I think in the past in agriculture we've tended to get pretty excited about minimizing taxable income and reducing our tax expenditures. And I guess all three of us in our discussions have really focused on the idea that this is not the time to focus on tax minimization.
That's right.
Tax minimization in the past has gotten some people in agriculture in trouble financially.
Right.
And we're a little concerned that some people right now could be making some decisions that could lead to some problems down the road, focused too heavily on the 2014 tax management strategy instead of the long-term profitability strategy, and especially the working capital strategy that you're outlining.
That's exactly right. And just to kind of take that a notch further, it's probably this whole tax issue is going to really show up probably not so much in our 2014 tax bill, which we have to worry about paying, because we're still going to we're going to have some pretty good sized taxes probably in many cases, but have some flexibility to move it forward this year. But it's next year where we're going to have real challenges, because if we don't have those profits, right, we're not going to have the same kind of opportunity to move income around the way we did before to minimize that tax burden. So we're going to find some farmers that have, exactly when they can't afford to have them, right, have these deferred taxes that they've been pushing forward come back to roost, right? We're going to have some tax bills that are going to be really surprising for some farmers, exactly when they don't have the cash to make those tax payments. And compounding that problem by doing it again and buying machinery. I mean, how much new machinery do you really need, right? I mean, I'm not that I'm trying to discourage the machinery sales, except it's a really tough decision to make, and you just don't want to right now compound your tax problem that you're going to face in the future by buying in this window.
It seems like the lender has a role in this too, Mike.
Absolutely.
And I can see those who are tax management oriented here that now we're down to a very narrow window. But they're saying, well, I can always go borrow from my lender.
Yeah.
And I guess I'm hearing from the lenders a lot more caution.
Absolutely.
So can you talk about this with regard to working capital and getting my taxes down as low as I can?
Yep, that's right. and that's a really important point, Chris, that you ought to, before you do this, at a very minimum, have a conversation with your lender and say, okay, here's what I'm thinking of. How are you going to react? Are you going to be willing to fund this, or are you going to fund my working capital deficit that I'm going to have? And you ask it that way, and I can tell you what the lender's going to say.
Yeah,
come on, what are you thinking?
Because you work with a lot of them.
That's right.
What are they saying?
They're saying we're going to be it's going to be tougher sledding this next year.
And my sense is a lot of farmers have not checked with their lender
That's
yet.
Right. That's right.
Year.
Absolutely.
And so from a strategy standpoint, I think one thing we're clearly saying is if you're thinking about making a purchase, hopefully because you really need the equipment, not because of a tax minimization idea, but you should talk to your lender first. Don't make the deal and then call the lender later. Talk to the lender before you strike the deal and make a decision.
So that does relate to this. If your working capital is already low, you ought to really, really worry first about rebuilding it before you kind of do make a lot of capital expenditures and those types of things. So in some of them have used cash to buy farmland, to buy machinery in the past, and they do have a relatively low working capital position. So the first thing on their list ought to be rebuild that before we start spending it in other ways and those types of things. Now, another way that we can kind of rebuild that working capital position and actually improve our longer term ability to handle financial stress is to extend out the terms on our loans. A lot of the money that farmers have borrowed has been borrowed on a shorter term repayment schedule. I mean, we used to make farm loans for 20 years, right, on mortgages for farmland. A lot of that has been on a 10-year payback. That was when margins were good. 10 years, we could maybe make those cash flow payments. We need to take that loan and put it back out on a 20-year basis. We bought a lot of machinery with debt and put it on a 3 or 5 year payback. Normally, our machinery loans are 5 to 7 year payback. So we shortened down those repayment schedules. And when incomes are good, that was okay. When incomes aren't going to be so good going forward, that puts real cash flow pressures on us. And the thing to do is to get ahead of the curve on that rather than find out that, oh, I can't make the payment. Now I better talk to my banker and see if I can extend the terms. Bankers are much less excited about doing that than if you go in and say, look, let's talk about this before we hit this problem. Let's talk about extending those terms, getting those terms longer term to get our repayment capacity better within our earnings capacity of the business, right? Getting our repayment requirements down lower by, will we have to pay over the term of the loan more interest? Yeah, but interest rates are really pretty low today. And they're going to go up a little bit, but they're not going to go up like they did in the 1980s where they went into high double-digit numbers. And so, and plus we can lock in the interest rates on it in terms of, that's another reason to have a conversation with your banker about this. We ought to, and your lender ought to talk about doing something to lock those rates in and extend the terms.
So really 2 reasons to do it. One is to improve your working capital position, and that's something people in agriculture are not really acclimated to.
Oh,
Non-ag businesses are probably a little more acclimated to
Absolutely.
trying to manage their balance sheet and manage their cash flows in a way that they actually restructure debt periodically. And ag, we tend to do it when we're in trouble.
That's right.
And we're advocating a different strategy. Be preemptive.
That's right.
Do it now.
That's
Most
right.
people are still in very strong financial positions.
Absolutely.
Look ahead the next 3 to 5 years and really do kind of a stress test and ask yourself, what's going to happen on my operation? Think about that burn rate.
That's right.
And take advantage of the fact that we've got low long-term rates. The downside of doing this is so minimal, given the current interest rate structure. It really looks like a good strategy to pursue.
Now we've got on the slide here, we also have this one that is always tough to kind of talk about, and maybe I need to really seriously think about some of the things that I was planning to do in terms of family living expenditures. What they've gone up almost doubled in the last 5 or 6 or 7 years.
Some of the farm data is showing at 75% to 100 doubling, almost doubling. That's correct. In family living. So
we're up to $75,000, $80,000, which isn't a lot of money, but on the other hand, it is a lot of money when I'm worried about whether I can make payments on my loans, right? And so maybe it's tough to do, but maybe the new car that we wanted to buy next year, or the improvement to the house that we were thinking of making to the next year. I'm not going to talk about the boats and the airplanes and all that kind of stuff, right? Maybe we just need to say, well, we're going to have to pull back on that. We maybe need to think about it. I mean, I know a lot of farmers say, well, health care has really hurt me, and I understand that. So probably have a hard time pulling those expenses down. Maybe we aren't going to pull back on college education funds. Well, no, probably not. But maybe student loan, right? A lot of student loan possibility. And you mean I'm going to put my children under financial stress? No. What happens is you help the son or daughter get a student loan, and when it comes time 5 years from now to pay it off, guess who pays it off? Mom and dad, right? So you reduce the financial pressure today associated with that educational fund and delay it until when times are a little bit better and you got more financial capacity to be able to pay it off. We see a lot of reasons why those types of arrangements to reduce that cash flow pressure today could be really valuable. And as we've already hinted at before and said, you really do need to be prepared for your loan review. Your lender is going to ask a lot tougher questions this time on loan review. We're moving in, and some have already gone through their loan review process, but a lot of this loan review activity is into the year and first part of next year. If you haven't had your loan review with your lender, don't just kind of say, okay, get up at 8 o'clock because I better get ready for this at 9 o'clock and head on in there and take a stack of papers in and hope that he doesn't ask any tough questions, because he's going to ask some tough questions this year. He's going to have some expectations that you have a better understanding. He's going to say, well, have you done calculations of what your break-even's going to be? And if you say, well, I haven't really done that, he might say, well, I'll work with you on figuring this out this time, but next year we're going to have you come in with those numbers rather than have me have to ask you about it, because that's where we're at. The break-evens now, we need to understand those if we're going to be thinking about our marketing and our financial strategies.
Mike, you called those tough questions. I'd probably call them good questions.
Yeah, I agree.
Right? Those are the questions that need to be addressed.
Absolutely.
And hopefully you've thought of them before you went in for a loan review.
Right.
But if you didn't and they come up, those are good questions.
That's right.
Those are questions that deserve consideration, and they're really designed to help you do a better job of managing through what could be a challenging time.
That's right. Absolutely.
Another point I think we're bringing up is we're just getting to the point where things are beginning to change.
Right.
And I think even as we have talked about, 14 incomes aren't going to be terrible for a lot of farmers because they sold a lot of the 13 crop at some pretty good prices into 14. They forward contracted some corn near $5 back in the spring and delivered it in the fall. Everything's good. But boy, you start getting down to high $3s or $4 corn, that changes really quick.
That's right. That's right.
So I think we're trying to wave a red flag in essence. Right. The sooner you start making adjustments, being more cautious, the better for the farm operation.
That's right. Absolutely.
Let's talk a little bit about input purchasing strategies, and to some extent maybe some usage strategies. But I thought it'd be useful, Chris, to think about why is that important. And I think if we look at some of these production costs, that maybe helps illustrate that. So you want to walk us through that a little bit?
For sure. These are, again, on our budgets on a cost per bushel basis. They are with budgeted yield. So at the, say in the winter time before we go into the planting season, we do come up with cost of production as well as estimated yields for that year. So we're not dealing with the actual, that is, years like 2012 would look much different when you had very small yields. But these give us a sense of moving total cost of production, the red line, from something in the high $2 range and basically doubling that, I guess is what we could say, on up to around $5 cost of production. So it's going to be important for us to break this down. What are those cost components? But we're looking for 15, not much moderation in cost of production, looking around that $5 per bushel. We also see the variable cost of production, and this is a little bit surprising to many people. That's the cost of putting the crop in the ground, the seed, the fertilizer, the chemical, getting it growing, getting it harvested, the direct cost. Those overhead costs now represent nearly half of the total cost of production. Right. And this is the nature of agricultural production. We have modest variable cost and pretty high fixed cost. It drives us to try to spread those fixed costs with more acres, with higher yields, etc. But we don't see much moderation in that for 2015, maybe the first hint of some lowering of cost of production for 2015.
Chris, interesting here because most graphs we have historically look like this have on that axis cost per acre. You've got cost per bushel in there. Is there a reason why you do this on a cost per bushel rather than a cost per acre basis here?
Well, again, these would be before we have yields or no one. I think it helps us to think about going forward. We need to see, to cover total economic cost, we need to see, with average yields at least, something in that $5 range and on corn and $12 a bushel on soybeans.
Yep.
So if we're not going to see that, and our outlook is more $4 corn and $10 beans, that says something has to give. Somebody's not going to get a full return for their economic inputs they're putting in.
Well, and I think the other thing that at least I like to have farmers get a better understanding of is they don't sell acres, they sell bushels, right?
Right.
And I mean, in livestock for a long time, Jim, we've quoted all of our stuff on
cost per hundredweight.
Cost per hundredweight, right? And it helps them think about their marketing strategy and what the important cost components are relative to the product that they're selling rather than to one of the inputs. So I think this actually helps them think better about their margins, because the margins are on a per bushel basis, not on a per acre basis, more meaningful in terms of marketing, cost control, et cetera.
Another point on this chart, Chris, that is interesting, a lot of times when I interact with farm audiences, people express some skepticism about the idea that cost would ever go down. But we've got some evidence just in the last 10 years of costs going down, particularly when we look at, what, 09 to 2010?
Right.
Right. We saw some impacts, some spillover impacts maybe from the recession, having an impact on the cost of inputs in agriculture.
That's right. And we did have fertilizer go down, so we do have some direct evidence from not too long ago that input costs can go down. And we also had cash rents come down a little bit back in that recessionary period, 8, 9, and 10, as well as land values. So that was with 1 or 2 years of downturn. We began to see adjustments even on the land side and cash rent side.
So it's realistic, even though we're not projecting a big change here in 15, as we look out to 16, 17, and 18, it's realistic to think we could see some adjustment in these production costs. And our challenge is to figure out how we can make that happen or maybe hasten that a little bit.
And again, I would say it more strongly. I think if we cannot have sufficient prices of grain, cost will adjust.
That's right.
The question is who's going to take less.
That's right. That's right.
So let's take a look at crop production costs specifically for corn, and look at it kind of from a percentage standpoint and figure out where the big buckets are, so to speak. So those big buckets are cash rent, fertilizer, seed, machinery, depreciation, and family living expense. Really the big buckets. We've got all the other ones on there, but they're not nearly as large as those 4 big ones.
Yep. And so as one starts thinking about, to Chris's point, that we probably have to get some cost reductions here, and the market will eventually result in that over time if the revenue streams don't recover, which we are at least our thinking is not going to occur very rapidly. You start thinking about where you have, in a way, kind of the sequence of what might happen in terms of cost reductions. Now, it isn't going to show up in terms of a big change in the slice, but the first adjustment process, which farmers typically and legitimately make in terms of trying to lower their costs, is and it's a cash cost, is don't make any capital expenditures. It doesn't. It's related to what we talked about earlier. I mean, okay, we just really pulled back in terms of any new purchases of machinery, equipment, storage facilities, tiling, whatever it might be, et cetera. So that's probably one of the first things. So that that pretty sizable green thing, we could possibly see some reduction there. Then we kind of look at, say, okay, well, what about this fertilizer bill? Is there some way to kind of think about, and will we see some adjustments in terms of fertilizer prices here? You know, everybody's saying, Chris, that you got to get your stuff because we're going to run out. I mean, we hear those types of stories out there, and there wasn't a lot of fall application, right?
That's correct.
On fertilizer,
yeah,
so people say we better, you know, but is there some flexibility down on fertilizer here?
Well,
what do you think?
we do see corn prices and nitrogen prices in particular do have some positive correlation to them. And again, we can understand that from the sense that corn is the big nitrogen user. So if you look historically, those are correlated about 0.6, 0.65. They're not perfect by any means. The other thing we see on nitrogen is that when corn price changes, it tends to be about 6 months to 9 months before that shows up in terms of the nitrogen price. So higher corn prices, we didn't see nitrogen immediately go up, but 6 months later, 9 months later, you see that move up. So I think that's true on the downside too, that we'll see some lags. We're looking on the demand side of fertilizer pretty clearly. Lower acreage of corn in southern hemisphere this year, lower acreage of corn in the United States next year. I think we've probably got some rethinking on application rates. And again, we do know when corn is lower price, that may not be a big reduction, but we may cut back some on application rates. We also know on the demand side, as you're talking about, if that cash gets really tight, farm fields that have strong P and K test, they could actually go below maintenance for a period. And we have seen that. We saw that in 09, a substantial cut in P and K because of the tight cash flow. So I think the demand side looks weak for fertilizer. Now the supply side, we have to get that in place, and the dealers and the manufacturers keep saying, no, it won't come down, it won't come down. I remember that in September of 2008 as the U.S. stock market was in a crash. Saying fertilizer can come down because we went from $7 corn to $3 corn. And it did come. It went down substantially. And again, I think those kind of shocks, those are major, major shocks. But we've got much cheaper fuel now in terms of the energy complex. Just from a transportation standpoint, this should lower fertilizer prices some. And again, we've used a lot of fuel in manufacturing of fertilizer. So I think all these things say some supply weakness and some demand weakness on fertilizer.
So Chris, you've just outlined a strategy there in terms of input purchasing. Some of us have maybe gotten acclimated to purchasing nitrogen ahead here in December before the end of the year. This might be the year where you look at a strategy of paying for it in the spring, maybe even a side dress program, and maybe delay those payments until you put it on next May or June. That might match up with the lags you're talking about.
And to the extent we have lower input prices in the future, we're better to wait to buy rather than to buy today. To the extent they do go down.
And so you see another big chunk of this seed area, and you know, we see that that seed prices are again lethargic to adjust down. They haven't adjusted down very much. Maybe the good news is at least the numbers are adjusting that they aren't going to go up like they have, because seed prices have gone up pretty fast. Now they've captured more of the traits, and so they've kind of replaced some of the chemical prices or costs that we used to have in the past. But what can we do there in that seed area? That's a big slice of the pie. Maybe we think a little about whether we need to buy some of these traits at $4 corn versus $6 corn. Maybe we delay again some of these decisions.
Yeah, I think that's probably the first thing I would look at, Mike, would be whether or not some of the traits that we're purchasing are actually needed in our particular geographic locale. There's been a tendency to market traits across the board throughout the Corn Belt. And I think this is a time frame when farmers ought to look very closely at local research, look to their land-grant university, whether it's Purdue or Illinois or Ohio State, you know, whatever school that might be closest by, and look at what the research suggests is needed in that particular locale, because there might be an opportunity to step away from, for example, some of the triple stack products and reduce some costs that way. There's some other opportunities. Look very closely at things like seeding rate. We've encouraged people over the recent years to really increase seeding rates pretty substantially because of a potential yield kick in a lower price environment, given the cost to seed. Some moderation in those seeding rates might be useful, and I think consistent with some of the research coming out of not only Purdue, but I think other land-grant universities around the Midwest. So those are a couple of things to think about in the seed area.
But we do need to always caution to say, look, be careful that you don't give up and pull back on all of these inputs so that your yield drops dramatically or cuts down dramatically. Because we're really talking about here about cost per bushel of yield output is the real issue, not cost per acre. Again, that's the real important
And that's the reason we put that first slide on a cost per bushel basis as opposed to a cost per acre. It's easy to reduce cost per acre. It's cost per bushel we want to reduce.
And again, I kind of see this as this era that we're moving into. Agribusinesses and farmers have not accepted yet that we're going to have this tight margin period. I still see this as a time period where what we're saying is who's going to blink first, who's going to cut prices, who's going to say we want market share. We're not going to give up market share because some other perhaps seed company we were talking about comes in, a maybe more localized regional seed company, and starts cutting price, gaining market share. So I think we're still in the who blinks first category. And that tells me that the later we get into the seed buying season, the more the opportunity for some firms to come along and say, we've got a lot of inventory. We've had huge production these last 2 years. We've got a lot of seed, and boy, that doesn't do much good for our company sitting in the warehouse for another whole year. So I think who's going to blink, who's going to cut. Once we get that process accepting we're going to have narrower margins, and everybody, maybe, or a lot of people, then that's when we start this process of really getting costs down.
I know who's going to blink first. It's going to be that landlord. Let's talk about the rent issue here. What's this rent issue look like? Maybe we ought to take a look at those rent numbers and see what they look like.
So let's take a look at cash rents, and this is on, first of all, on a per acre basis. Cash rent was about 28% of our total cost in 2014. And on the slide, I've depicted a projection, maybe a guesstimate, as to what's going to take place with respect to cash rent in 2015. We do think there could be some moderation in average cash rental rates. And I think a couple of things are going on in that area. One is, as you look at some of the extreme high values we've all heard about the last 2 or 3 years, those seem to be going away pretty rapidly. That's first and foremost. Secondly, we're probably going to see some moderation in some of the other longer-term relationships. And from my perspective, where that's probably most likely to happen is going to be in a situation where you had good communications with a landlord on the way up when returns were very good, and you were more willing to share some of that increase in the margins that we talked about earlier on the way up. That puts you as a farmer, as a tenant, perhaps in a stronger situation to have a discussion with that landlord about the fact that, hey, the world has changed quite a bit, these margins are a lot tighter than they were, and we need to make some kind of an adjustment. Let's take a look at those.
And just a quick point on that. One of the advantages of having maybe previous to now negotiated a flexible cash lease is that conversation is, in a sense, already had occurred, right? So you got more now flexibility on the downside. If you set a base plus a premium type of thing, now you don't, because the landlord already understands that, okay, I still got my base, but I'm not going to be expecting as much of that premium payment as I would have if I had a fixed cash rent type of thing.
And crop share leases are automatically probably going to be down lower, and the cash rent flex leases are probably going to be down.
That's right.
So we've actually got a pretty good segment, cash rent's still the biggest of the segments, that are going to be down.
That's right.
And so I think this tells the landlord, or, you know, my argument would be the tenant needs to be talking this year for sure about, as Jim says, those narrowing margins.
Right.
And even if they can keep it the same this year, next year, if this doesn't change, we can't go multiple years.
Right. Absolutely.
So communication is huge, right?
Absolutely.
And it might not result in a change in that cash rental rate in 2015, but it sets the stage for a change perhaps in 16 and the years out into the future. And you know, again, I've put this slide on a dollars per bushel basis to look at the impact on cost on a per bushel basis. We're projecting a pretty modest decline in those rates. I think the number we've got factored in here is about a 5% decline. That's pretty consistent, I think, with some of the research that's been done. I know one of our colleagues, Michael Langemeyer, has looked at that pretty closely and suggests, first of all, we know from history that cash rental rates do adjust. A little bit like some of the things you were talking about earlier, Chris, there's a lag, and they tend to adjust slowly. So we do anticipate over the next several years, if prices unfold the way we think it's possible, we're looking at a multi-year change in cash rents. And it's going to be slow. But it is going to take place, and I think we're pretty confident about the direction anyway. So, let's take a closer look at seed cost. Because that is one that has really skyrocketed in recent years. In 2005, it was about 8% of total cost. Here, the last couple of years, we've been up around 14%. You look at it, the percentage increase since 2005, Chris, do you remember what that was? I think.
Well, it's almost tripled. And so the cost per acre is almost tripled. And again, one of the things that goes in, we're talking about corn seed. We're on the corn commodity here. And in this visual, if we look at 2008, you see a big surge in 2008. Now, this is on our budgets, our Purdue budgets, and guess what we did? There's where we shifted our seed to triple stack.
Right, right.
And so there is a genetic component. Or we might think about that as you can't just look at your cost per acre because there was substantial qualitative or value change maybe there. Yep. But still, even soybean seed is double the cost. And I think what we have is the genetics. This was a time when margins were high and the genetic companies were really able to maybe extract some pretty good returns for that genetics that they were providing.
Right.
Going forward, again, I think this is one of those big wedges of the pie that's very large, has become very large, as you see here on the graph. Right. And will they hold price as we go further? And I think even if they hold price, early pay discounts, volume discounts, all kinds of incentives. Companies don't like to lower prices. They like to give you incentives.
Right. And I think a really important part of this graph and what we ought to have farmers in the pie charts we've got is that, again, you can find out where the big buckets are, where your expenditures are, and that helps you kind of think about what you ought to be focusing on in terms of getting these cost reductions. Because probably, Chris, we're going to talk a little bit later about marketing strategies on the product selling side, but probably, Chris, in this environment, we need to probably up the bar in terms of trying to do a better job of marketing on the buying side. We don't think of marketing enough on the buying side as maybe we need to. We haven't had to, or haven't had to.
We've not been in a situation. We more or less have said at the farmer level, just give me that. Yeah. Give me that service. Yeah. Protect. Give me the fungicides, give me the foliar feeding, give me the seed treatments. Just give them to me. Protect that big value of that crop.
That's right.
That crop doesn't have big value anymore. We probably don't need all these things, at least in some cases. Evaluate them.
So let's look at that input side a little bit in terms of strategies. We've already kind of talked about some of them. First point, we again, just to reemphasize, it's really cost per bushel we need to worry about. Buying right sets your cost structure is really important. And as I tell farmers frequently, you know, if you pay too much for your inputs, you're behind the power curve before you ever take the planter out to the field, right? You got to really, really work hard at getting those costs under control. And so more than you might have in the past, you need to check around alternatives. You need to negotiate. You need to think about how to help your seller understand your viewpoint that, you know, we're worried about making sure we make money. We want you to make money too. But on the other hand, we need to have the best pricing we can, and I can get it the same service and the same kind of reliability from supplier A. So you need to, supplier B, you need to think about that. We just have to negotiate much tougher than we have in the past. And then we've got some other things we can do in terms of, we've kind of hinted at, that we can do in terms of just application rates, et cetera,
well,
right, Jim?
I think one of the keys is to use the best available management practices. And if you think about crop fertilization, one of the things to think about there with, for example, a key input like nitrogen is, are you really using the best management practices? You know, a lot of the research would suggest split applications is the way to go.
Right.
It's more efficient.
Right.
It might put you in a position of being able to actually reduce rates and still keep productivity high. That's a way to reduce cost per bushel, and still move forward in an effective way. Herbicides, some opportunities there. Chris, you were mentioning fungicides.
Yeah, mentioned fungicides. Again, I think it's coming back to evaluating. Make your best evaluation. Do I have these problems on my farm, or are they in my community? And again, this is kind of the Purdue agronomy line. If you need those treatments, yes, use them. But if it's not in your community, don't just go buy those because, well, in case that particular insect or disease came along, then I have protection.
Yeah, so one of the things that comes to mind there obviously is more intensive crop scouting.
Exactly.
I think and then only applying when you really need it. Some of the strategies that some of the companies have offered in the recent past has been to try and encourage you to buy those post-application products in the winter to take advantage of cash discounts. We would suggest waiting and purchasing those in season when and if you need them.
And if you need them, right. So up the bar on scouting and other types of things, which I think in another seminar we're going to talk about, this whole execution issue, doing things that we maybe got a little bit lax in doing when we had these better prices and incomes. Now we need to kind of return to doing some of the basics again.
And it includes products, evaluating products and services. So
That's
I think
right.
a scout certainly has
That's right.
services.
So getting the best price on a product and not having them be able to deliver it when you need it, because timeliness of getting that crop in is always, always important. So making darn sure that you aren't behind the power curve, needing the fertilizer applied on that field and it's not there and you wanted to plant it.
And when margins are high, it's easy to just say, give me those services. I'll take them all, the products, the services, the wow technology, that's really neat. Now we evaluate that differently. We don't buy wow technology. We buy technology if it's cost lowering.
That's right.
We buy the service if we can't provide it ourselves at a cheaper price. So I think we think about this much differently.
Chris, let's talk a little bit about some marketing strategies. We've alluded to some of these, but let's be a little more explicit. And your first one you mentioned is becoming a little more cautious. What do you mean by that?
Well, and again, I think this is when you have big margins and those margins seem to be growing each year, that's the time to be aggressive. It's the time when overall prices are headed up. You would want to sell later, sell your products later than earlier, because overall product prices, grain prices are headed up. Now I think we've got and another point of that is when you have big margins, you cannot make a mistake in marketing. Prices are always above your cost of production, and whatever you do in marketing, you're always making money. It just could have been more money. So again, I think when you have these narrow margins, that really says you can't mess up on the marketing side a whole lot and give up $1 a bushel when you already had negative margins. So I think it just suggests that we really, certainly one of the last points there is to focus on margins. We really want to think about margins. Now, if input prices, we're laying out this idea that this is a multi-year adjustment to the downside, maybe on some of these input prices. If that is the case, or if we think cash rents are going down, then we would tend to not want to price today, but wait till tomorrow or wait till later. Or as we've seen in the last 2 weeks, should you buy gasoline today or wait till tomorrow? And the last 2 to 3 weeks, it's been wait till tomorrow. Input prices going down, and I wait till tomorrow, I get a cheaper price. Now that's a concept. Each of you have to make your own decisions on that. Think about cash rents. Don't lock in multiple years of things like cash rent or other inputs if there's a chance those prices could go down. So I think we understand that. On the way up on cash rents, we were saying it the exact opposite. Lock in input costs for multiple years if you can do that, because everything seems to still be moving to the upside. So that flips. A lot of our strategies on the upside flip now on the downside. Basically, I think this idea of forward contracting more aggressively does come around the margining concept. And that is, we're looking at narrow margins, we think, for the next several years. And one of the first things that we want to do in narrow margin time periods, make sure we're going to be there to farm for another year. So I think, again, this is part of the more cautious. We know our cost. We're willing to do pricing with more modest returns than what we've seen before. We get into marketing, and we get back to, let's just earn the basis appreciation. Let's make sure we get that 30 cents of basis appreciation. Well, that 30 cents didn't seem like it meant a lot when corn was $8, but when it's $4, that's where you can make some money. And that has very good odds of doing well in terms of those storage returns. And again, focusing on margins, knowing cost, being willing to do some forward pricing when we have that opportunity. And I think there's some marketing implications in the government program as well that we talk about in our sessions of providing some protection and thinking about what is that price that you're going to get out of the government programs.
Chris, one thing I think of when we talk about things like focusing on locking in the margins, we've been through this before, right? To some extent,
not new.
To some extent, this gets back to managing the way we did throughout perhaps most of the 1990s, the first half of the first decade of this millennium, right?
That's right.
So it's not something we are completely unfamiliar with.
That's right.
We got away from it because margins got very attractive for a while, and we started making some decisions that in that kind of environment made pretty good sense. But now we're looking at a different environment. We've got to step back a little bit and literally tighten the belt and evaluate everything we do a little more carefully and ask the question, is this really contributing to yield? Is this particular input purchase contributing to yield? If it's not, if it's just an insurance strategy, then I've really got to think about whether or not I want to use that particular input. Am I using the best management practices, the most efficient way possible? Those are some key questions that we maybe have gotten a little bit lax on the last couple of years.
This whole playbook is kind of up on the top shelf, and we haven't had to pull it down for quite a while. What we need to do is pull this playbook down, dust it off, and say, okay, here's how I used to run this business. Here's the pressure I was under. Here's the kind of decisions I made. Now I need to kind of revisit those and kind of do. It's you know, it's not as though we haven't been here before. Farmers can do this. We know they can do it. They have made it through these more financially pressing times, and so it's a matter of kind of looking at those strategies. We don't have a silver bullet here that says, okay, the world's going to kind of all of a sudden turn around on you. We don't think. What we need to do is just take out the old playbook and start doing what we know how well to do.
Yeah, I think those are really important points. And again, we'll go back kind of where we started, and that is we don't think this is a bust. We think we're going into a moderation period, and that involves adjustments.
Right.
The playbook is different, and we've seen that playbook before, and we've been very good on the farm at figuring out how to exist, hitting singles instead of those home runs that were a lot of fun here for a few years. So I think that's a great message. That is, let's get started making these adjustments. And hey, if it's better than that, you can always adjust to the upside.
Well, and I think it's really important to understand, if I get some of these adjustments made and the future is a lot brighter than what we think it is, I just mean do it a lot better on the upside.
That's right. That's right.
Because I got my cost structure under control. I got my productivity, efficiency under control. It's kind of a win-win no matter what the future holds. I'm better off.
Yeah. And again, I don't think, we've said it many times, but producers, farmers should be asking for lower. And again, this is negotiation. This is get those cash rents out in front of your landlord and talk to them about how these margins have collapsed and how you're going to have to do something at some point. So I think that's a much different world than we've been in.
And it's a world that a lot of us are not acclimated to, in the sense that we haven't been having those conversations routinely. It's one that we need to start initiating, and it's going to take some time.
That's right.
Right? You don't have that conversation once and have a big change in, for example, your cash rental rate. It's going to take some time, some communication there, and make sure the other party actually understands what's taking place. We've got a question from a viewer I think we should try and tackle here. Let's see. I'm going to rephrase it a little bit. I think it's essentially saying, when do you make a decision to walk away because cash rent's too high?
That's
right.
Really,
if your cash rents, how do you make that choice? When's the choice variable there?
I'm sure Chris has got the answer to this one. This is just so easy, Chris. I'm just going to pass it to you.
Yeah. Well, you know, we do have a cost structure that is about roughly on corn. We looked at about half of that cost structure is the variable cost, and half is the machinery. It's the family living expense. It's the cash rent. It's the overhead kind of cost. So I think the bottom line for the cash rent tenant is, number one, they want to be bigger. They don't want, and there's powerful economics from farming more acres. We know that with these big overhead costs. So I think what they actually come back to is they argue for lower cash rents. They show their budgets, and that's why I think it's important for us at Purdue to show how much collapse we have in these margins. They argue that, and they ask for it, but not to the point they lose the land. And so then how much, if you come back, can they actually bid? They have to recover at least their variable cost and maybe a little bit more than that, but that's about it. And when it really comes down to it, if we're thinking about market power, who has more power at this point to stand in there and not take a cut? The landlords really have a lot more power than the cash rent tenants. It has to be where most of the cash rent tenants in that community say, we can't do this anymore. We've given up too much of our wealth in the last year or two. And I think that's why we're saying it'll probably be another year once we really, if we do get into this.
But the chances of having the adjustment occur next year are enhanced if I start the conversation
Amen.
today. Right?
I think that's...
And that's the key thing, is that, you know, if I were to be more direct on this, I really would work hard to negotiate on the cash rent. Really, really work hard. Not expecting necessarily to get a lot of adjustment this year, and if I don't get adjustment, saying I'm out of here, I'm going to not rent it. Generally, that would probably not be a good thing to think about doing this year. But if, in fact, I don't have that conversation this year, the chances of getting an adjustment next year are lower, right? And next year I might. If I don't get any adjustment at all, and I don't get any adjustment next year on top of it, now I start. And maybe what I start doing this year is even having conversations with others that say, okay, maybe I can rent that piece of land over there as a replacement for this one, and I can get it at a better price, right? So we start thinking about alternative. I mean, this is what the business world does. If I've got a supplier, i.e. land, who is not willing to make adjustments, I start looking for alternative suppliers, right? And I don't wait until I've lost this piece of property or this supplier to be looking for alternative suppliers. And so maybe I start having those conversations this year, not only to get this adjustment next year in the land rental, but also thinking about starting scouting around. What kind of replacement? Is there somebody that's probably going to retire that has been farming himself? I ought to have a conversation with him today rather than wait till next year. And I think there will be some farmers that are now 73, 74, had a good run, and they say, hey, I'm thinking about retiring next year. This doesn't look to be as much fun as it was. I need to have identified those and say, okay, if my current landowner won't adjust, I'm going to go over here and I'm going to start that conversation today with Sam, who we think has the potential of retiring, and we'll figure out the deal.
So our answer is if you can cover your variable cost of production, and you're making a contribution to those fixed resources, we would encourage you to stick with that property here in 2015, initiate some conversations, and start setting the stage for possible reductions down the road if margins really are as tight as what we're anticipating. And I think that's one of the challenges right now is we're talking about what could happen.
Right.
I think there's probably a lot of landlords sitting there thinking, well, I'm going to wait and see if that really does happen. Right? And I think that's one of the challenges that we have out there.
I agree with that. And again, the landlords say, well, tenants, you've had a pretty good run here of margins. You should have a reasonable cash position. And maybe next year we'll be back to $5 corn. So can we work one more year? On the other hand, you know, there are a lot of really great working relationships between tenants and landlords. And I know many landlords that really look to their tenants to tell them if things are tighter, and they're willing to accept some cuts. That almost the tenant sets that rent.
Particularly if that operator has shared some of the upside with them in the past.
That's correct. And maybe on a cash rent flexor that gave them some
They're more
extra.
willing to think about, okay, you know, he shared the good times with me. Now I'm willing to kind of help him on the downside.
Well, I think our time is about up. We've exhausted our hour. I guess the good news is if you're interested in more on this, we've got more webinars scheduled coming up here after the first of the year in January, February, and actually one in March. So we'll have more information on those webinars coming out very soon from the Center for Commercial Ag. I
think one of the next ones we're going to spend a fair amount of time on this execution issue, just doing everything better than you have. We got a laundry list of things there.
Really zone in on the strategies that you can use with maybe some more clarity and a little more detail with respect to the production practices you might pursue that would help you get through this and be just a little more efficient than you have been in maybe the last couple of years. So with that, I want to say Merry Christmas. On behalf of the Center for Commercial Agriculture and Purdue Extension and my colleagues, we appreciate you joining us for not only this webinar, but the series of programs we've offered, and we'll be offering more. I want to mention that we do have a series of programs coming up in early January. We did a webinar a couple of weeks ago focused on the farm program. We're going to do more of those programs live around the state of Indiana in early January. The first one of those is on January 6th. We've got one in, I believe that's in Wabash. On January the 8th, we're down in Batesville, Indiana. On January the 9th, we're here in West Lafayette at the Beck Center out at the Purdue Agronomy Farm. And then on January 15th, we'll have a workshop as part of the Fort Wayne Farm Show. So if you're still struggling with that farm bill decision-making process, and I think most people are in that category, we'd encourage you to consider attending one of those webinars or perhaps visiting our website. And when you do that, you'll have a chance to view, with a couple of clicks, you could view any of the webinars that we've recorded here in the recent past. So with that, Merry Christmas and a Happy New Year, and thank you for joining us.